Good morning, everyone. We're going to go ahead and get started. Welcome to the second and final day of the CFPB Research Conference. My name is Judy Ricks. I'm an economist in the Office of Research at the CFPB. So we're going to get the morning started off with panel 3, titled Information in Mortgage Markets. We have 3 presentations as part of this session, which will be followed by a discussion. If time permits, we'll open the room up for questions. The first presenter in the session will be Lauren Lambie-Hansen from the Federal Reserve Bank of Philadelphia, who will be presenting on information losses in home purchase appraisals.
Good morning, and thank you to the conference organizers for giving us a chance to present this paper. This is joint work with Paul Kalem and Leonard Nakamura, and while we all work at the Philadelphia Fed, of course I'm obligated to tell you that this presentation reflects our views, not our employers. So I apologize, the title that I have today is Appraising Home Purchase Appraisals. This is different from what's in the program. We took one big paper and broke it into 2, and what I'm showing you today are the more recent results with some newer data that we have that I'm excited to show you, so we're extra interested in getting your feedback. All right. So we're focusing on home purchase appraisals, which are supposed to serve 2 main purposes. First, they're supposed to inform the lender of the value of the house, which is serving as the collateral for the loan, and they're also supposed to be helping the buyer avoid overpaying for the property. But are appraisals truly objective? Well, increasingly, evidence has shown that many appraisals are upwardly biased or inflated. For example, according to the 2011 FCIC report, as the housing market expanded, a problem emerged in subprime and prime mortgage markets alike, inflated appraisals. And one 2003 survey found that 55% of appraisers had felt pressure to inflate the value of homes, and by 2006 this had climbed to 90%. The 2009 Home Valuation Code of Conduct and the Dodd-Frank Act instituted rules to improve appraiser independence, but appraisal biases are still common. As a 2014 Wall Street Journal headline put it, dodgy home appraisals have made a comeback. So given that appraisals are widely acknowledged to suffer from problems, what value do home purchase appraisals provide and to whom? That's the main focus of our paper. So let's take a moment to talk about how this process works so we're all on the same page. You choose to buy a home, you make an offer, you go back and forth with the seller, negotiating, and finally you agree on a contract price. If you need a mortgage, which most Americans do, the lender will order an appraisal, which you, the buyer, will pay between $300 and $600 for, typically, for a standard appraisal. Now, the lender is going to choose the appraiser, or increasingly in today, they'll choose the appraisal management company who will choose the appraiser, but you will pay for it. The lender wants to ensure that the property, the collateral for the loan, is as valuable as you think it is, and because that affects your default risk and how much they could recover if they have to foreclose. So all of this affects your loan-to-value ratio because the LTV is calculated as the loan amount divided by the lesser of the appraisal amount and the contract price. So why is the LTV ratio so important? A higher LTV, a smaller down payment, means that the buyer is going to pay more for a loan. And this possibly through higher interest rates, but definitely once you're over 80% LTV through higher mortgage insurance costs. So the relationship between LTV and a borrower's MI payments increases in steps above specific LTV notches, which we're going to refer to these as notches, which I've shown in red here. So above 80, 85, 90, and 95% LTV, there are increases in mortgage insurance costs. And 97% is an important notch because that's the highest LTV you can have now for a GSE loan. So this is a chart that looks at the amount of MI that a borrower would be responsible for each month, a borrower with good credit who's buying a house for $200,000 and allowing the LTV to vary. Okay, so if a house is more expensive than $200,000, of course, or if the borrower's credit is worse, they would pay more than these amounts. So at 80% LTV, and a borrower doesn't have to buy mortgage insurance, but if he puts any less than 20% down, he's got to pay about $45 a month in MI, and this increases to almost $80 a month above 85% LTV. After each notch, there's a large increase in MI costs because lenders require higher levels of MI coverage. So as a result, borrowers try to locate at LTV notches. This is some data on 2013 to 2015 mortgage applications for 30-year fixed-rate purchase mortgages. And this is showing the frequency of these applications by the applicant's desired LTV. So this is the LTV when they approach the lender, they know how much they want to borrow, and what the contract price is, so before the appraisal comes in. And we see big pileups at especially 80, 90, and 95% LTV. But the borrower's desired LTV may not be the final LTV that they receive. It depends on the outcome of the appraisal. If the appraisal comes in less than the contract price, if we would say it's a negative appraisal, then the denominator of the LTV is going to be smaller, and that's going to result in a higher LTV, which could result in a higher cost mortgage. So if the appraisal comes in low or negative or below the contract price, all the same thing, then the borrower has to decide what to do. If you're the borrower, you can put up a higher down payment to keep your LTV the same. You can accept a higher LTV loan, which may cost more. You can negotiate the price with the seller, or you can decide not to buy the house. You can walk away. And most buyers have put an appraisal contingency in the contract, which allows them to walk away and keep the earnest money that they put up at the contract if the appraisal comes in negative. So this, you can see how this would serve as an incentive to the seller to renegotiate that price down if the appraisal comes in low. Now, if the appraisal comes in greater than or equal to the contract price, everyone more or less forgets that the appraisal ever happened, the transaction goes through, and everyone is happy, right? Well, are they? If the appraisal was biased upward to get to that level, then the buyer has effectively overpaid and has lost the opportunity to exercise this appraisal contingency clause in the contract. Now, what does the lender think? They're considering two types of costs. If the appraisal is negative, the transaction may fall through, which they want to avoid. But on the other hand, an inflated appraisal means you underestimate the risk that the borrower will wind up with negative equity and default. The appraiser, meanwhile, wants to retain the lender's business in the future. So he's going to act to help balance these two competing costs that the lender perceives. What information does an appraiser actually receive? So here's a typical appraisal order form. The appraiser knows the purchase or contract price. They also get the loan amount, so they can do the simple division and get the LTV. They can tell if a borrower is at a notch, and therefore if a negative appraisal is likely to bump a borrower into a higher LTV class and a more expensive mortgage. So appraisals are undertaken, right, to provide independent assessments of property values. So how often do you think that appraisals come in below the contract price? We might expect that if they're truly objective, about half the time the appraisals are going to come in below the contract price and about half the time they come in above. Is that what actually happens? No. Appraisals very rarely come in below the contract price. Here's a chart from the first paper of the two, and the one I'm really not presenting today, that shows the distribution of appraised values versus contract prices for mortgage applications in 2007 to 2012, applications that were ultimately approved and ones that were denied. So less than 9% of appraisals came in below the contract price. And note the tallest bar here, 34% of the time, the appraisal comes in exactly identical to the contract price, down to the penny. So we might expect that sometimes the appraiser would arrive at the exact same value as the buyer and seller did, but 34% of the time, really? So note also this asymmetry in the distribution, especially in the bars just to the left and right of the mass point. 17% of the time, the appraisal comes in positive above the contract price, but within 1% of the price. But only 0.4% of the time do they come in negative, but within 1%. So if you're sitting thinking to yourself, you know, maybe the appraiser just assumes that the contract price is a very meaningful value, and that if they differ a little, they're just going to default to that. They're just going to go default back to that contract price and report that. Well, if that's what's happening, if that's the kind of adjustment that's happening, it's really only made in one direction, right? Up. This pattern is not new. We're not the first people to find this. This has been shown in the literature for 20 years, that appraisals follow this kind of distribution. What we're adding, though, is we're arguing that if you arrive at an appraisal exactly equal to your contract price, information loss has occurred. Because some of the appraisals that fall in this mass point truly are because the appraiser believes that the value is equal to what the buyer and seller agreed on. But you can't distinguish those from the ones where bias has occurred. There's significant heterogeneity in where this information loss occurs, the percentage of appraisals that come in equal to the transaction price. For mortgage applications in 2013 to 2015 in California, over half of appraisals were exactly identical to the contract price. Contrast that with Mississippi, Maine, and West Virginia, where 14 to 15% were equal. And in the first paper, we talk about how this, there seems to be evidence that this is tied to house price appreciation. If prices are appreciating, the appraiser perceives that there's less default risk to biasing up the appraisal, and will do so. So I've already shown you some of the data already, but to give you a little bit more sense of what we're using here, we have proprietary data from one of the GSEs. We're using two main types of data. The first is mortgage applications from 2013 to 2015 for 30-year fixed-rate purchase mortgages, and these include both loans approved and denied. And it's important to include the denied applications because otherwise negative appraisals that result in transactions have a selection bias problem. So we observed the contract price, final sale price, applied for and final LTV, borrower characteristics such as credit score, debt to income ratio, the county of the appraisal, and so on. And the big question we're asking with this data set is, do loans at LTV notches experience more information loss? Are they more likely to come in at the contract price? Then we want to answer the question, who cares if they come in equal to the contract price? One way that you might care is if those loans are more likely to experience default. So we go back in time, we take 2003 to 2009 mortgages originated, and we look at about 1 million of these mortgages, and we ask, is information loss correlated with an increased probability of default, which we're defining as 180 days or more past due. We add county-level house price trends from Zillow, demographic data from Census, and foreclosure rates from McDash. Okay. So we do find that information loss is more common at LTV notches. This chart is showing the percentage of appraisals that come in identical to the transaction price, conditional on not exceeding it. Why do we do this conditional? It's cleaner because it takes out the appraisals that come in on the positive side of the distribution. What we argue in the first paper is if the appraisals come in positive, if they come in high, that they're truly high, that the borrower truly is paying less than what the appraiser thinks that the property is worth. And why? Because there's no incentive in terms of the LTV rule to bias the appraisal up if you're already above the transaction price. It doesn't help the borrower's LTV. All it does is potentially impose a greater default risk. Okay, so looking at the percentage of appraisals that come in equal to the contract price, conditional on being less than or equal to the contract price, we can see that there are these jumps in the information loss at the applicant's desired LTV. When we estimate linear probability models to confirm this information loss at the notches controlling for the year of the appraisal, the state, the house price trends leading up to the appraisal, foreclosure rates in the communities, all these things that could influence whether the appraiser actually goes ahead and biases up the appraisal, we find pretty consistent results. We find that on average, the appraisal is about 8 percentage points more likely to equal the contract price if you're at a notch than right above or right below a notch. So a borrower at 90% LTV is about 8 percentage points more likely to have that appraisal come in and hit the number than one at 89 or 91% LTV. And we find that this result is really robust to things like adding in appraiser dummies, lender dummies, segmenting the sample and running it by region. We see the same pattern that information loss is more common at these LTV notches in Sand States, West Coast, and even the Rust Belt. But is information loss a problem? I want to convince you that it is in two ways. The first is that negative appraisals can help borrowers renegotiate. While they may kill the deal, when they don't, they help the borrowers renegotiate. So among the sales that actually do occur in the face of a negative appraisal, 57% were renegotiated. The price came down between the buyer and seller. We don't think that these renegotiations largely would have happened in the absence of the negative appraisal. Why do I say that? Because only 2% of the time that the appraisal came in at or above the transaction price did the buyer and seller subsequently renegotiate for some reason. And if the negative appraisal is likely to bump you up into a higher LTV class and a higher cost mortgage, 71% of the loans that were actually originated with the negative appraisal were renegotiated. And these savings to consumers are significant. The median savings at renegotiation was $6,000 or 2.5% of the typical transaction price. Another way to think of information loss, whether it's a problem, is this default risk. Does biasing appraisals make them riskier? And we do see that there's more information loss at those notches, as I've shown you, and that there are higher default rates at those notches where the information loss occurs. So this chart's just showing the percentage of loans that default within the first 5 years, and we can see that at all but the 80% LTV that we see increases in default risk. And we think that the 80% LTV, would be interested to talk with you more about this, but we think it's because borrowers are largely very low risk at 80% LTV. A lot of those borrowers could have put more down but did not. So overall in the sample, the default rate is about 6% in this sample of 30-year fixed-rate mortgages. And when we run linear probability models for the default risk and we control for all the things you normally would in a default model, we find that at the notches, borrowers are 1 to 2 percentage points more likely to default than comparable borrowers just below or just above them, 1 percentage point higher or lower in terms of LTV. And to make things more interesting, we divide up the sample and run the models by whether the appraisal came in below, at, or above the transaction price, and we find that the results are strongest. Default risk jumps most at the LTV notches when the appraiser had reported the appraisal equal to the transaction price. So while there could be a variety of reasons why people at the default at the LTV notches default more, one of them does seem to be due to this information loss in the appraisals. Okay, so to recap, bias and information loss in appraisals are very common. Less than 10% of appraisals come in below the transaction price. More than a third come in exactly identical, down to the penny to the transaction price. And that is more likely to occur at LTV notches. Although they may wind up killing a deal, negative appraisals do seem to help borrowers renegotiate sales prices. And where appraisal loss is most common at those LTV notches, we're seeing an economically and statistically meaningful increase in default risk. So what could be done about this? Well, we think we could experiment with the way that property valuation is done. Maybe we shouldn't have this LTV rule that uses the minimum of the contract price and the appraised value. Just let the denominator of the LTV be the transaction price, carry out the appraisal, and use it as an additional piece of information that the lender can use in underwriting. Maybe allow the appraiser to report a range of values rather than just one single estimate. Freddie Mac announced last month that starting in the spring, it will allow some appraisal-free mortgages. So lenders would instead use Freddie's automated valuation model, or AVM. And while I didn't go into it for the sake of time, we've been looking at the predictive value of AVMs versus appraisals, and we've been finding some pretty interesting results that perhaps the AVMs are more predictive of default risk than appraisals, especially when the appraisal would have come in below or equal to the transaction price. So thank you for letting me present this. Because this is a work in progress, we're very interested to get your feedback, and if you would like the most current version of the paper, please do email me. Thanks.
Thank you, Lauren. Our next presenter is Ben McCartney from Duke University. He's presenting on identifying social influence in household mortgage decisions.
Thank you all for being here today, and thank you to the CFPB for organizing this conference and including our presentation. We're excited to be here and to get your feedback. Today we're going to talk about social influence in household mortgage decisions. I don't have to convince this room that they're important, but particularly important today is that they're complex, that there are thousands of lenders that offer a variety of mortgage types, and that households have to choose a lender, choose a mortgage, and then decide over the life of the loan if and when to refinance. And their decisions have consequences, which makes it important for us as both policymakers and academics to understand what drives households' mortgage choices. The CFPB recently did a survey and they asked people, how do you make these decisions? What do you take into account? And more than half of people cited their social networks as important sources of information. And it's this idea that we're going to rigorously explore today, and we can confirm that social influence, specifically in this project, neighbor social influence, has a dramatic effect on a household's lender choice, whether or not they choose an adjustable rate mortgage or fixed rate mortgage, and if they choose to refinance. So this is a tricky thing to identify. If we just look at this map of northern LA and plot all the houses and the decisions they'd make, we would surely find that households behave like the people around them. But just because we have this spatial clustering in mortgage decisions doesn't mean that we conclude there's a social influence effect, that neighbors matter, and there's two main problems. The first is what we call endogenous group formation, and this occurs when similar households live together and similar households make similar choices. So there's no social influence, it's just similar people make similar decisions. And also correlated unobservables, which is a problem when people who live in the same neighborhood are being affected by the same things. And this is particularly problematic to the econometrician because if we can't see these things, they're going to bias results. So we're going to solve these problems by zooming in a bit. So this block here, the dark gray block, is a census block, which corresponds in LA exactly to a city block. And there are approximately 25 households on this block. Throughout this paper, we're going to define a neighborhood as the block itself and the adjacent blocks. All right, and the assumption we're going to make is that households can choose their neighborhood, but are less likely to choose the precise block they live on. If you imagine a household who's relocating or who's buying a house, they drive around, pick an area they like, say, look, I want to live in this area, and then see what properties are available and pick one. And it could be that sometimes there's just not available properties on a specific block, or they are just truly indifferent between one block and the block right next to it. But the idea is that of the 200 neighbors or so, you're choosing those 200 neighbors. We grant that, that's fine. But what we're saying is that the 25 people that live closest to you, your hyperlocal block peers, they're randomly assigned. So when we think back to the two problems, the endogenous group formation has been fixed because we're saying you're endogenously choosing your neighborhood, but you're being randomly assigned hyperlocal block peers. Your next door neighbors are random. And also the correlated unobservables are fixed because of how far we're zooming in. We're going to say that if something is affecting a block, it's also going to be affecting the people that live across the street. So with this assumption in mind, we can write down this model. It's a linear probability model, and the key variables are the block share and the neighborhood share. So the neighborhood share is the percentage of people that live in your neighborhood that are making a decision, and the block share is the percentage of people that live on your exact block that are making the decision. We also include a variety of controls, and in our preferred specification, time-fixed effects. It's important to note that block peers are also neighborhood peers. I like to think of blocks and neighborhoods as a wedding cake, where the neighborhood is the bottom layer and the block is the top layer. And the assumption is that which top layer you end up on is randomly assigned, and this specification is going to ask, conditional on neighborhood share, do you behave especially like your block share? And since your block peers are randomly assigned, this beta 1 is going to estimate a social influence effect or a peer effect. So the key findings are that households do behave especially like, over and above their neighborhood peers, their hyperlocal block peers, when choosing lenders, when choosing adjustable rate mortgages over fixed rate mortgages, and when choosing whether or not to refinance. We also find that refinancing households are subject to this social influence effect, but purchasing households are not. And this makes sense. A household that's getting a purchase loan hasn't lived there, there's been no social interaction with the neighbors, they're not affected by a social influence effect. Also, movers, people moving to a new area, don't behave like their peers, but over time do. And finally, non-occupant owners, so people who own second homes or investment homes but don't live there, don't behave like the property's neighbors, despite having a property there. And then convincingly for us, the non-occupant owners, even when making decisions about their second homes, which could be miles away from where they do live, make decisions in line with the people that live near their actual house. And our conclusion is that a social influence effect from hyperlocal peers is an important economic force in explaining household mortgage decisions. I'll go over the data set quickly. It's a panel of households with their mortgages in Los Angeles. It's the universe of Los Angeles mortgages. And we're going to focus on the period 2008 to 2011. We were concerned going in that if we used the anomalous bubble period to identify a social influence effect, it would make it challenging to conclude that this was an important effect and not just some bubble-specific phenomenon. For each household, we have information on the new loan if they take out a new loan, or if they don't, we have information on their outstanding loan, provided that loan was originated after 1992. For each loan, we know what its purpose was, whether or not it had an adjustable rate, and we also have information on the borrower, the property itself, and the lender of the loan. So some quick summary stats. There's a much longer table in the paper, but these are the ones we'll focus on today. The key point of the first panel is that most loans in this period are refinance loans with fixed rate mortgages. Most loans are originated by banks, with mortgage companies coming in second, and credit unions and finance companies also important. The largest lender in the sample is Wells Fargo. They originated 13% of the loans. There's more stuff on the lenders in the paper, but for this presentation, we're just going to focus on Wells Fargo because they're the largest. Then this distance to property miles, this is the distance between the mailing address that the borrower uses and the address of the property itself. So for the vast majority of cases, this is 0, when it's a person who is at the house who is either refinancing the loan or is using their new home's address for the mailing address. But either for people who are moving and would like to use their old address for the mailing address, or for non-occupant owners, this distance to property measure is positive. Co-applicant is a control variable we use that is 1 if there's 2 people on the loan. So think of a couple versus a single borrower. So here's the picture we looked at before, a block and the neighborhood. The neighborhood is the block itself and adjacent blocks. And we want to see if people behave more like the people in their block, conditional on the people like their neighborhood, in their neighborhood. So this is the data mapped to that geography. Each circle corresponds to an outstanding loan, and the circle is shaded in if it was originated by Wells Fargo. You'll notice there's a blank block. That's because there's an elementary school there, so there's no properties, no outstanding mortgages. You'll also notice there's places where you think there might be houses and there's not. These are either things that are just stores or vacant lots, or properties that are owned by institutions or banks or non-household owned. So we're going to focus on the owner-occupied refinances as opposed to the non-owner-occupied or the purchase loans, because we think that the owner-occupied refinances, the people who have lived there, are the people who are at risk for being socially influenced. Other people haven't had a chance to socially interact. So this is going to be the main sample we look at for now. This is what we could call like the naive regression, what I talked about in the first slide where I talked about the identification problems. Obviously, people behave like the people that live near them. But there's a variety of reasons this could be the case, that we talked about. The key thing we do in this paper is control for that neighborhood share and say all those things you're concerned about, all the reasons this is an endogenous correlation, are soaked up by the neighborhood share. And we see that even when we allow for a household to behave like the people in its neighborhood, they behave especially like the people on their block. So they're more likely to choose Wells Fargo if their next door neighbors have chosen Wells Fargo. We can do a little better than this by including both quarter fixed effects and quarter by census block group fixed effects. Block group is the census delineation right above census block and contains an average of about 10 census blocks. So the 2 results here that we like are, the first is that in the first row you can see even once we include these fixed effects, the estimate is very steady over specifications 2, 3, and 4. And also you'll see that the neighborhood share, the importance of the neighborhood share in specification 4 is completely nerfed, which means that the specification we've written is kind of working as intended, that our model works as intended, because that quarter by group fixed effect soaks that all up. The next thing we look at is whether a household is more likely to choose an ARM if their hyperlocal peers have chosen adjustable rate mortgages, and that's exactly what we find. It's the same sort of thing as before. In row 1, we see a very steady estimate, and the neighborhood share goes away in specification 4. The last decision we look at is whether a household refinances or not. And we see that they behave, again, like the people in their neighborhood, but they behave especially like the people that live on the same block as they do. If more of their hyperlocal peers have recently refinanced, they are more likely themselves to refinance. So these are the bulk of the results, and we take this as consistent with the idea of a hyperlocal social influence effect. We also do some robustness tests. We can match about 60% of the sample to HMDA and include a bunch of demographic controls, and the results are robust to that. And also, in the previous tables, we've been using a lender type fixed effect right above the quarter fixed effect. And we have a fixed effect for bank or mortgage company or credit union or finance company. But a concern that a lot of people had is this just like a specific lender thing? So what we do is look at the sample of loans that were originated by the 18 largest lenders. so those lenders that have originated more than 50,000 loans in the sample, include a lender fixed effect and find that the results are robust to that as well. Then also, we've been using census block and adjacent census blocks as our definition, but it's important to note that the results are also robust to using census block and census block groups as the two measures, or to using 0.1 mile radius circles around the property and 0.5 mile radius circles around the property. Each of these have different pros and cons, and I'd be happy to talk to you more about them if you have questions. So let's talk a little bit about the magnitudes. So we've seen that the signs are important. Here we can see that a 10 percentage point increase in the share of your block peers that have made the relevant decision increase your probability of choosing Wells Fargo by 3%, an ARM by 1.5%, or refinancing by nearly 10%. This is in line with other work in this area. These are two great papers, one about teachers teaching teachers, and find that a teacher who has a randomly assigned teacher with the same off period is more likely to refinance if their peer has refinanced. And the Facebook Friends paper finds that households whose Facebook friends have experienced property value increases, are themselves more likely to switch from renting to owning and to buy a bigger property when they do, among a variety of other things that they find. We want you to take away from this slide that likely all of these estimates are lower bounds. When we talked about social networks on the first page, people have in mind both friends and coworkers and neighbors. Each of these papers is using a different group, and while they're not mutually exclusive, there are certainly peers that are in one group and not the other. So likely the true social influence effect, if we're concerned about that as policymakers, is larger than what any of these papers are finding independently. So now remember we were looking at refinances by people who live there. Now we're going to look at the non-occupant owners. So you can think about people who own vacation homes and just don't live there most of the year, or people who own second homes with the explicit purpose of just renting them out and they never live there. So when they make decisions, are they affected by the people that live near that property? We would expect no, because there's no chance for social interaction, and therefore no chance for social influence, and that's what we find. This is the same table as before for refinancing, and we find that the people who own these properties, when making their refinancing choice, are not at all affected by the share of the people who live on the same block who have recently refinanced. Similarly, when they're making the choice between an adjustable rate mortgage or a fixed rate mortgage, specification 2 is the one we saw earlier with that sample of refinances by occupant owners. But when we're looking at non-occupant owners who are refinancing and taking out a new loan, so even though they've owned the property for a while, they're not being at all affected to choose an adjustable rate mortgage by their block peers because they don't live there, and there's no chance for a social influence effect. But what about their actual neighbors? They do live somewhere. They have a primary residence. When they're making decisions about their investment property, do they behave like their actual neighbors? With the caveat that the results are significant at the 15% level, we find that yes, they do. It's a small sample to be sure, which is why we think the results are maybe, but we find this is like incredibly exciting because there's not a lot of the other stories that people come up with about all the results we've shown so far are inconsistent with non-occupant owners who make decisions about their investment properties being affected by the people that live near them, even when the distance between the neighbors that they actually have in the investment property are miles apart. The last group we're going to look at is the movers. So these are people who purchase a home in an area they haven't lived before. And what do we think is going to happen to them? So all of the results I've shown you before, we've also run with purchase loans and find that there's never any results. But what happens after they've moved there? So when they first move there, they're not affected. Again, no social influence, no social interaction, no chance for social influence. For the people that continue to not live there, so for the people who it turned out were buying second homes or investment properties, as we just saw, again, no social influence effect. But for those people in column 1 who then did move there and later refinanced as occupants, their decisions were socially influenced by their block peers, again, over and above their neighborhood peers. So our conclusion today is that neighbors matter. We found that households making mortgage decisions are socially influenced by the decisions of their hyperlocal neighbors over and above the decisions common to people living in their neighborhood. And it's likely that our magnitudes represent the lower bound of the true importance of social influence effects. We find corroborating evidence that distance movers aren't initially influenced by their neighbors, but eventually are when making refinance decisions, and that non-owner-occupied households never experience social influence effects from property neighbors, but do from their primary residence neighbors, even when the primary residence and the second home are miles apart. So the takeaways here, we imagine important consequences for consumer welfare. Previous work has found that households are probably not refinancing optimally, and work by the next presenter has found that predatory lending is indeed an issue. And we think that both in designing policies aimed to fix these problems and in evaluating the policies themselves, we should be considering the role that social influence plays in how households make mortgage decisions. Going forward, we're looking at the role that expertise plays in these. Specifically, are experts more likely to be influencers and less likely to be influencees? And also, we kind of brushed aside the bubble for this purpose because we wanted to focus on a true economic story, but we think that that time period is important enough that it's going to warrant its own line of inquiry. Finally, because I have a little time left, our working idea for the mechanism here is that this is word of mouth. So there's not lots, but there are projects that have found that people make decisions like their hyperlocal peers, specifically that they're more likely to install solar panels if their peers have solar panels or buy cars similar to what their neighbors have bought. But the difference between this story and those stories is that I can see if my neighbor installed solar panels, or I can see if my neighbor bought a BMW. But it's difficult to know if my neighbor refinanced without talking to him. So even in the age where social media has become increasingly important, we find that social influence effects, specifically word of mouth effects, are still playing an important role in the economy and how households make mortgage decisions. We look forward to your comments and hope to talk to all of you for the rest of the day. Thank you.
Thank you, Ben. Our third presentation is by Jean Ammerman from the Federal Reserve Bank of Chicago, who will be presenting on loan product steering in mortgage markets.
Thanks very much. Thank you for inviting our paper to be presented here. It's quite an honor. So this is joint work with Sumit Agrawal, Tahib Ben David, and Doug Evanoff, who are our long-term co-authors. So during the housing run-up, there are multiple allegations of unscrupulous lending behavior. You have doubtless heard stories or seen papers that looked at predatory actions, all sorts of things related to fees, falsification of information, not just by lenders, but also by securitizers, et cetera, et cetera. And so in this paper, we tried to look at a particular type of lender behavior, which we call lender steering. In particular, we're asking whether lenders steered borrowers to more profitable contract types. Now, steering has a long and kind of sordid history in consumer protection and lender behavior. So I want to just be clear that what we mean by steering here is a simple fact of lenders guiding borrowers toward mortgage contracts that have features that are highly compensated by the market. They may or may not be useful for the borrower. We don't take a stand on this. It's easy to come up with examples of borrowers that have highly variable incomes for whom option arms are perfectly fine, borrowers that would not be able to get a loan unless it had a prepayment penalty. But for now, we just do not take a stand on this. So in an ideal world, we would have some lenders that follow steering protocols and some lenders that do not. And then borrowers would be randomly assigned to different, basically, underwriting regimes, would be able to approve them and then compare the outcomes. We don't have that. And so there are multiple identification challenges. For one, we don't know what information borrowers and lenders possess. We do not know what kind of contracts borrowers request at first. And we basically do not know what the proper control group should be. And so we have to find for a setting where some of these concerns, at least, might be allayed. So this is mortgage steering in a graphic form. It may be a bit of an overstatement that spin and double XL mortgages with triple lots were an option, but it's not that much of an overstatement. And so if we wanted to operationalize this decision-making process, we imagine a flow chart that's something like the following. We have a mortgage applicant that approaches a lender that fills out a request for a kind of a standard run-of-the-mill, plain vanilla 30-year fixed-rate mortgage application. A lender evaluates the borrower, and those of them who are judged to be not creditworthy are rejected, and then they have a hard time finding loans elsewhere. Those that are creditworthy kind of have a fork in the road, if you will. So a lender can just go ahead and approve the initial application, the initial plain vanilla fixed-rate mortgage application, or they might be tempted to reject the initial application and try to steer the borrower to a different product type. In some of these cases, they will succeed. and then the lender or their specialized affiliate will approve the loan. In other cases, they might fail, and then the borrower will just walk elsewhere and get their loan elsewhere. Now, steering might be tempting simply because it's more profitable. There's enhanced profitability comes from actually multiple sources. There are higher fees associated with more complex products. They generate better pricing in securitization pools. They offer more profitable servicing opportunities, etc. And so the empirical strategy that we're going to follow to try to get at this question is to focus on a group of borrowers that's going to be relatively small relative to the universe of all mortgage applicants, whose applications were rejected at first, but then very shortly thereafter approved. Now, some of these borrowers were approved by the original lender or their affiliate. Other borrowers just went elsewhere. An important caveat here is that what we do not see is any instances of steering that are not recorded, basically. So those are the instances that occur when the lender would not take an application prior to convincing the borrower to take a particular contract form and then get it recorded and reported through HMD, as you'll see. And so our test would be to contrast these two groups of borrowers along a number of dimensions. And the null here is if the initial rejection is just unaccompanied by any ulterior motives on part of the lender, these two groups will be very, very similar. So let me skip that. So our data, we are working primarily with HMD data, the non-public version of it, because as you will see in a second, it's very important to have the exact application date for each of the actions. We're going to supplement this data with mortgage servicer data from McDash, and that is important because it allows us to see contract terms of mortgages that were eventually originated and compare them as well. To determine the status of different lending entities being affiliated, we make use of call report data that gives us insight into the structure of the bank holding company, so bank holding companies and their multiple subsidiaries. So the first step we need to make is to generate the sample of people who get denied and then approved shortly thereafter. So we match up all applications in HMD that have perfect matches in terms of census tract, the race and gender of the applicant, the number of applicants that's not listed here, loan type, purpose, occupancy type. They have to be the rejection and origination approval have to be done within a relatively short window of time. We start with 30 days and we expand it up to 60. And then we also match iteratively on loan amount and income. We start with an exact match and then we increase the bounds in increments of $1,000. Until for going as far as $5,000 in each direction. So when we carry out this exercise, we end up with roughly 3.5 million pairs of denials and approvals in the 1998-2006 HMD editions. Once we pair those records with an identifiable bank holding company that may have affiliates, we're down to 1.3 million. And when we further match it with McDash, our sample becomes about 300,000 loans deep, 90,000 of which are loans originated with affiliates, and the rest are people who have gone to shop elsewhere. What we also want to do is we want to establish a tight covariate balance between what we call the steered borrowers and the non-steered borrowers. And the way in which we do this is for every borrower that got a loan with an affiliated lender, we look for a very similar borrower that literally went elsewhere. The similarity is they're required to be residing in the same state, originating their loans within a 90-day gap of each other, have same purpose and occupancy type, and they have to be similar in a propensity score sense in terms of their incomes, home values, FICO scores, LTVs, etc. When all is said and done, we have 72,000 steered borrowers and 72,000 one-to-one matched non-steered ones. This is what that sample looks like. You'll see that the applicants have reasonably high credit scores. They have reasonably high incomes. They have low loan-to-value ratios. They're not the ones that would jump out at you as being people that are particularly on the margin of creditworthiness. So let's compare them. From now on, the exercise is very simple. We have our treated group, we have our control group. We want to see how they line up in terms of various characteristics. We're able to take into account in some specifications at least, their borrower, their own characteristics of their mortgages, and then account for a number of fixed effects. So the numbers in the red box suggest that controlling for the type of mortgage contract that steered borrowers get, they end up paying higher interest rates, substantially higher as a matter of fact. So these estimates suggest anywhere between, let's say, 40 and 70%. Now, these are important numbers in economic terms. If one were to use industry multipliers that are commonly employed to convert interest rate flows into some capitalized rates, and those multipliers rate anywhere from 4 to 7, you'll end up with estimates between $2,800 and $10,000 in extra profit on a simple, I guess, on a typical $200,000 loan. These are big numbers, especially compared to historical profitability of mortgage originations throughout this period. But those were just pricing, right? Is there anything else that's specific to the mortgage product? What are basically the triple lots products that we would like to look at? For that, we just turned to a number of industry studies on relative profitability of different mortgage contracts. So there's evidence that interest-only contracts have been just very profitable for lenders. Many CEOs of companies, reputable and not very reputable, have got on record discussing which products actually generate the highest profit margins for them. And you see that option arms are a very appealing and commonly referred to product. They're also not just product types, but product features, such as having prepayment penalties or low DAC loans, right? All of these have been associated with really high profitability during this period. So again, we're going to carry out the same exercise and just compare the types of contracts and contract features that have been taken by different groups of our borrowers. So we see that steered borrowers, literally borrowers that just went, that stuck with their original lender, end up having these triple lots products. Interest-only, option arm are much more prevalent among the steered borrowers, as are contracts that have prepayment penalties and that rely on very little documentation, low or no documentation at all. And again, not surprisingly, given the different avenues for securitizing or funding these loans, you will not be surprised to see that steered borrowers' mortgages were much more likely to end up in private securitization pools as opposed to being funded on portfolio. Now, a somewhat surprising result, based on what we know about ex-post performance of non-amortizing loans in particular, is that at least during this time period, the near-term delinquency of steered borrowers is actually somewhat better than borrowers that went elsewhere. Part of it probably reflects their ability to refinance mortgages while the prices were still going up. You might recall that the last mortgage originations in our sample came in 2006, so basically right on the cusp of prices turning down. But there's much more work that I think we need to do with this. So the remaining question is, well, which borrowers were the ones that actually stuck with the original lender and ended up with these expensive products? So for that, we go back to HMDA, right, and we look at a number of variables that capture social demographic status of applicants. And the picture that comes from this analysis is that female borrowers, borrowers that did not have a cosigner, basically single borrowers, and borrowers that resided in low to moderate income neighborhoods were the ones that were more likely to have gotten steered, to have remained with their original lender following the rejection of their initial application. And so in summary, this paper is an attempt to identify a particular lender practice that's difficult to observe directly for obvious reasons. What we try to do is compare outcomes of borrowers that are ex ante similar, that are also creditworthy, but that get their application rejected or withdrawn for whatever reason. And then the difference is some of them stick with their original lender and others go and shop elsewhere. And so what we show is that there are systematic differences between these two types of applicants that we think are consistent with a particular form of credit steering, namely steering borrowers towards higher profit products for the lender. And the way to interpret the last result that I showed you is that steered borrowers tend to come from demographic groups that have been associated with lower levels of financial literacy. And so let me end on a redemptive note, and thank you for your attention.
morning. I have the privilege of discussing these three papers. My name is David Lowe. I'm an economist here at the CFPB. So I want to begin by reminding you of the contributions of these papers so I can then discuss how I think of them as a whole. So first, we just saw that lenders can steer some borrowers to expensive mortgages, where expensive is defined as more expensive than they could otherwise obtain. We also saw from Ben's paper that mortgage refinancing decisions are influenced by immediate neighbors, which is, I think, fascinating and new. And we saw from Lauren's paper that home purchase appraisals are biased in predictable ways. So what are the contributions of these papers as a whole? So the literature already has shown over the past several years that information in the mortgage market, broadly defined, is imperfect in many ways. And each of these papers highlights the role of a specific information provider in a specific submarket of the mortgage market. So we saw that lenders provide information in the market for purchase mortgages, neighbors provide information in the market for mortgage refis, and appraisers, who are chosen by lenders, provide information on the value of housing. So the question I think these papers raise as a whole is, can these information providers do better, which would be one important question to answer on the steps towards improving the mortgage market. And if these information providers are inadequate, could others do better? So that's what I want to think about today. So let me begin. Each of these papers is in a different submarket, and these are all different submarkets. So let me discuss each individually. So beginning with the market for purchase mortgages, there's already several papers that show that there's significant dispersion in fees and interest rates. And what I mean by that is that consumers could obtain similar mortgages or identical mortgages except at a lower price. And if they did that, they would save many thousands of dollars. And it just, economists tend not to think that it's plausible that search costs are so high. So it's not that consumers know these mortgages are out there, they just don't want to go to the effort. It just seems to be that consumers lack some important information about whether they may not know that the returns to search are so high, or they may not know how to search effectively. So there's obviously a role for information providers in this market. And that's just on prices, which it's pretty easy to look at the interest rate on a mortgage. There are many other much more difficult trade-offs consumers have to make when choosing a mortgage, such as whether to get a fixed rate or adjustable rate mortgage, whether it's a 15-year or 30-year mortgage, et cetera. In general, because these trade-offs are so much more complex, it's generally harder to show consumers make mistakes and are uninformed about what they're doing. But I personally find it very hard to be optimistic that they're informed about these decisions when they don't seem to be well informed about fees and interest rates. So we need to think hard about who's providing information in this market and what their incentives are and what their effect on the market is. So that's why I'm very excited to be discussing this paper. So lenders, we saw today, that lenders steer some borrowers to expensive mortgages, and specifically that steer borrowers pay more and default less than borrowers who are not steered. And this dovetails nicely with a working paper by Lowe et al., who show that banks influence the fixed rate and adjustable rate mortgage decision through information. But what I found really exciting about this paper is it shows two things. One, that lenders have incentives to mislead borrowers. And two, this is a little more questionable, but I think really I find convincing, that competitors don't seem to have much incentive to educate these borrowers, because if you remember, Gene and his co-authors compare borrowers who are steered to borrowers who go on to competitors of the original bank. And they basically show that the competitors do not do as well with this than the original banks. And why is that important? This brings me back to a theoretical paper by Gebex and Leipzig, who show that if the products in a market have shrouded attributes, and what that means basically is consumers don't fully shop based on the cost of those shrouded attributes, then you can see a market like this. You can see a market where companies have an active incentive to mislead their consumers, and the competitors do not have a financial incentive to educate those consumers. And this is important because it helps us think about why information in this market seems to be being provided in a suboptimal way. And realizing or understanding why it's being provided in a suboptimal way is the first step towards trying to improve how information is provided. So I think we should think about whether or not this is a story we buy in this market, and then that will teach us how to incentivize lenders to educate borrowers in a more effective way, whether it's from the original mortgage lender or the competitors. And we need to think harder about what the alternatives are. If lenders can't be relied on to educate borrowers, which might be the decision or the outcome, then we need to think about who else needs to step in and do a better job of providing this information. So that's the market for purchase mortgages. Let's move on to the literature on refis. And similar conclusion, consumers seem to make significant refinancing mistakes. There's a well-known term from the industry, woodheads. So woodheads do not refinance at all when rates fall, thereby losing many thousands of dollars compared to what they could get if they refinanced. But even people who refinance often wait too long or not long enough and seem to lose lots of money over a fairly simple one-dimensional variable that they have a choice over, which is about when to refinance. And obviously, just like purchase mortgages, people refinancing face many much more complex trade-offs, such as how much equity to extract, what terms of the new mortgage to get, et cetera. So again, it's harder to show mistakes in this market or with these complex trade-offs, but again, because consumers make such basic mistakes about when to refinance, it's hard for me to be optimistic that they're getting this right. So again, there's a really large role for information in this market. So then the question becomes who's providing this information and what is the effect on the market? And as we saw today, which is very exciting, mortgage refinancing decisions are influenced by immediate neighbors. This is very hard to explain with a standard model, and I think is immediate evidence that refinancing behavior is either not optimal or not informed. But as authors point out in their paper, this is not necessarily an information story, so it could be something they call a social utility. So if I see my neighbor get one kind of mortgage that makes my utility of getting that mortgage higher, I don't find this completely plausible, but it is worth keeping in mind as a possibility. But more importantly, there's two other kinds of behavior that could be going on. It could be social learning. So if my neighbor gets a kind of mortgage, and then I talk to that neighbor, and I realize that kind of mortgage would be good for me, that's social learning that improves my outcome. It could also be hurting when I'm just copying my neighbor, even though it's not good for me. So I think the really important next step is to figure out which of these three explanations it is, or which are the ones it could be. So I was going to push Ben to think harder in their paper about trying to get at this question by looking at who's most likely to influence or be influenced, and specifically, are influence outcomes more likely or less likely to be optimal? Sounds like that's kind of something they're working on already, so I'm very excited to hear that. I think the literature should be moving in that direction, and that will help us know whether information being provided through neighbors is a good thing or a bad thing, and whether we should encourage or discourage it. And that's refis, so let's move on to literature for housing. So very briefly, I think the literature in housing has shown, for various reasons, related to search frictions, there's considerable price dispersion in the housing market. So a single house at a single point in time can sell for a range of prices for many different reasons, such as the liquidity of the seller, the bargaining skills of the buyer-seller, et cetera. And a bunch of macroeconomists have shown that these have important consequences, such as seasonality in prices, extra cyclicality in prices, et cetera. The main takeaway for us today is that valuing the home is really hard, and this really matters. So getting to the specific paper on home purchase appraisals, we saw are biased in predictable ways. In that chart you saw of the distribution of the difference between appraisals and purchase prices, or transaction contract prices, you saw that 15% of appraisals are for 5% or more of the transaction price. I find this to be really stunning. If you believe that the true distribution, as they argued, should be roughly symmetric about zero, this means about 30% of appraisals are off by 5% or more. When you're talking about an object worth hundreds of thousands of dollars, that's a stunning amount of money to be off. So that's an indicator to me that the literature is right, and that transaction prices have a lot of variability in them. But also, of course, we all know that valuing a home is also very important for mortgage lenders, and home equity is one of the most, if not the most, important predictor of mortgage default. And if you take these two facts together, valuing a home is hard and it's important for mortgage lenders, it is all the more stunning that given these things, lenders still actively choose to suppress home value information in order to save some mortgage deals, as we saw. I would push the authors to think a little harder about whether this outcome is really suboptimal. It certainly feels wrong that someone whose job it is to produce information ends up actively destroying that information. That feels wrong, but it's not necessarily suboptimal in a constrained sense anyway, because this legislation requiring these appraisals and the LTV calculation exists for a reason. It exists because society and the economy may not want mortgages to be made that the mortgage lender wants to make for macroprudential reasons. And given that the legislation is probably pretty awkward in requiring the minimum of the appraisal and the transaction price to be used as the value of the price in the calculation, given that legislation is kind of awkward, then lenders may be responding optimally by kind of biasing it in this predictable way. So if you take these two things together, it's not clear to me this outcome is really that suboptimal. It certainly could be. I would just like to be more convinced of it. And also, I would like to see more discussion of what, if this outcome is suboptimal, what would a better outcome look like? And the authors argue that we should just be using the transaction price of the home in this LTV calculation and not really care in this calculation about the appraisal at all. And I'm not fully convinced about that. I'd like to see that fleshed out in more detail. Again, because as I hopefully convinced you, the literature has shown there's lots of evidence that these transaction prices are really quite noisy. And I don't think we should be relying on them alone. If, for example, if you imagine a new homeowner who buys a home with a 3% or 5% down payment, and 15 or 30% of those outcomes are really quite noisy, and in fact, those 5 and 3% down payments don't really exist at all because they're overpaying for the home, then all of a sudden, a large proportion of new homeowners are immediately underwater as soon as they buy their home. And I don't think that's good for anyone. So as we saw today, there's many important consequences of information in the mortgage market. So I think that these papers together help us think about how to improve information in mortgage markets. And specifically to answer that question, which is where I think the literature needs to go, is we need to answer the questions: who provides information, and how does that impact the market, and can we do better? So these papers provide some answers. Mortgage lenders steer borrowers, which is probably not a good thing, but we need to think harder about that. Neighbors inform mortgage refis, and purchase appraisals are often biased upwards. So the next steps, maybe for these papers or the literature as a whole, I think should be who could provide information in these markets if these information providers are not doing the job they should be doing, and also, can we incentivize the information providers to do a better job than they are? Thank you very much.